when we look at money market, in definition, we can find by definition the lending and borrowing take places for short period of time. When you compare with the capital market, lending and borrowing take places for medium and long term. So money market transaction will held within 12 month within 12 month maturity, and capital market matures more than 12 months. And types of instrument involved in money market. Money market generally deal in promissory notes, bills of exchange, commercial papers, treasury bills, call money, etc. In the capital market, you can find the capital market deals in equity shares, debentures, bond, preference shares, etc. So institutions involved, types of investors. When we look at the money market, where the money market contains banks, central bank, commercial bank, financial companies, cheat funds. When you look at the capital market, so it involves the stock brokers, mutual fund, underwriters, individuals, individual investors, commercial banks, stock exchanges, insurance companies. The nature of the market, money market, are most of the times informal, and capital markets are more formal. The liquidity of the market, money market are more liquid than capital market. And the maturity on the money market, the maturity of the financial instruments is generally up to 1 year. So capital market matures longer than 1 year. So risk factor in money market, since market is liquid, the maturity is less than 1 year. So therefore, risk involved is low. In capital market, due to less liquid nature and long maturity, the risk comparatively higher. Purpose of participating in money market, the market fulfills the short-term credit needs of the business. Capital markets, the capital market fulfills the long-term credit needs of the business. Functional merit, the money markets increase the liquidity of funds in the economy. Capital market stabilize the economy due to long-term savings. Return on investment, the return in money markets are usually low because less risk. And in capital market, the return in capital markets are high because of high duration associated with a long period of maturity. Now we'll discuss about primary market. You know, there are two different market, primary market and secondary market. So this categorized mainly in the capital market. Capital market can be divided by further primary market and secondary market. The primary market, you see the picture, company A. Now it's unlisted company. In case of Sri Lanka, unlisted company mean the company is not yet registered to trade the shares in the main board of the CSC. So listed company means they already registered and they are trading their stocks in the stock market. So unlisted company, it means still they are not entered into the market, and they have an idea to get fund from general public investors. So what they have to do is it has a long process. It's called IPO, initial public offering. First time company going to issue its equity shares to the general public. So therefore they have to list in the capital market, Colombo Stock Exchange in Sri Lankan context. So once the company decided to issue its equity shares for the purpose of raising fund, it has to change the status from unlisted company into listed company. So how they are goes to the stock market and for the purpose of getting fund from investors through IPO. Once they have done IPO, the company become listed company, right? So the primary market is that part of the capital market that deals with issuance of new securities. Here you notice the word new security, not existing securities. New security. The first time they are going to issue shares publicly for the purpose of getting fund. Also referred to as initial public offering market, primary market, sometimes called as IPO market. One of the main function in the issuance of new securities to investors is called underwriting. Actually speaking, underwriting is a different concept. It means, say, uh, a company A is going to issue shares in the general public in the stock market. So that time company A have to pass through several legal procedures, legal steps, and they issue thousands of shares, millions of shares in the general public. So it has some specific task, activities, special knowledge. So normally the company is hiring a bank, development banks, a merchant bank to handle this kind of legal requirements. And the development banks take responsibility to sell their shares at a good price. So this kind of promises, this kind of activities are called as underwriting, right? This kind of this intermediary, the promising things called underwriting, right? Underwriting. They undertake their shares and they're promising that we are going to sell the shares. This kind of promise. For that they are getting fees from the bank, sorry, company, issuing company. So one of the main functions in the issuance of new securities to the investors is called underwriting. Dealers dealers earn commission. So underwriters are dealers. So they are going to sell the shares in the market. So dealers earn a commission that built into the price of the security offering. Through it can be found in the prospectus. Prospectus, when the company is going to issue shares publicly, they wanted to issue a prospectus, right? They wanted to issue a prospectus. In the prospectus you can find all the informations regarding the company. So the goal of the IPO, right? The goal of going public, this means IPO, is raising capital or funds, raising capital or fund. When we talk about the functions of here, underwriters organizing the share issuance, underwriting, they take responsible and distribution of the shares. So these are the things will happen in a primary market. And here you see here a company through dealers, through underwriters, they are issuing shares to investors and money will go up. So this issuance will be happening in stock changes. There are many investors in the stock change. So they are secondary market. Here primary market. So what they do is, in the primary market, once the company issues shares to the investors, the money will flow into the company, directly flow to the company. But in case of secondary market, already traded shares, issued shares in hand of the investors, and they come together in this exchange, they are changing, they exchanging for profit, for return. So due to this transaction, there is no cash inflow to the into the company, issuing company. A company's government or public sector institutions can issue equities or bonds through a new issue. Not only company, government also can issue bonds, stock, so whatsoever in the form of initial public offering, new issue. So due to that, the money will inflow to the issuing entity. So this is typically done through syndicate of securities dealers. Syndicates mean a group of experts. They are undertaking the new issues procedures. To issue a stock of a company, it passes several legal procedures, legal documents. So company sometimes may not have enough capability to handle all the legal requirements and documentations. So therefore they are uh, handing over this part to some external body. So that body is called as a syndicate of securities dealers. Normally uh, it is provided by development banks or merchant banks. Here, when you look at here, the later these issued securities are traded on the secondary market. They are exchanged among the investors. Mr. A sell Mr. B, Mr. B sells to C, C sells to D. So, right, but due to this transaction, there is no money inflow or outflow to the company. When we look at the features of primary markets, number one, this is the market where long-term securities traded for the first time. Very important word. So first time. It's a market where long-term securities are traded for the first time. In an IPO, initial public offering, the securities are issued to the investors directly. Securities are issued to the investors directly, thereby issuer is sharing its ownership with investors. Right? So due to the IPO, a company should give a part of the ownership to the general general individual investors in the market. So they are getting money from the investors, general public. For that, they have to share their ownership with them. Funds thus raised is used for setting up new businesses or expanding existing businesses. So the purpose of IPO is to get fund. So they are getting a big amount of money, a large sum of money. So that amount of money will be used to start up a new business, or it can be used to expand the existing business. This market does not include the long-term loans from the banks or other lenders. So the IPO here does not include the long-term loans. There is no loan from the banks or other lenders. Equity issues to the investors. So when we talk about on international market, Alibaba raises at least 21.8 billion in record of IPO. So capital raised in the 10 largest US IPOs. In the history, In the stock market history, Alibaba has a record. They have raised a maximum amount of IPO amount, right? Maximum amount they raised in September 2014. Before that, Visa put the record 17.9 billion, and Facebook 16 billion, and General Motors 15 million likewise, right? So this data is up to 2014, right? 2014. But recently, when we look at the world biggest IPOs, so Aramco, so Aramco is the Arabian oil company, Arabian American companies, right? Share sales surpasses Alibaba's to become the world's biggest IPO, right? So at present, Aramco, so oil exporting company in Saudi Arabia, so they have raised a largest amount of money. So it's about 25 billion. So they supersede Alibaba. They put record in 2014. And when we look at in Sri Lankan context, so dialogue records highest amount of IPO. Dialogue's IPO remains the largest ever listing on the CSC, Colombo Stock Exchange, to date at a value of rupees 8.5 billion. 8.5 billion is the highest amount in the CSC history. So the shares were subscribed by 6.5 times with over 52.6 billion in subscriptions. Right? You compare our Sri Lankan market with the world market, right? So billion dollar. So we are still in. We also reached billions, right? Good. We are moving in a good path. It was happened, I think. You can search. So when it was happened, right? Right. And secondary market. Now we will discuss about secondary market. Secondary market, also known as aftermarket. A secondary market is a financial market where previously issued financial instruments are bought and sold, traded, right? So this is not the first time. Already a company issued shares. So for example, Dialog at time of IPO, they issued shares in the primary market. So due to that IPO, the Dialog company able to raise the fund from the public. Then the investors sometime wanted to sell the shares to other investors. So due to this transaction, there is no cash inflow or outflow to the Dialog company. So the cash flows will occur among the investors. So look at the picture. The company issues shares to the investor A, and investor A will give money to the company. So this is primary market. A secondary market, here investors, investor A, investor B. So they are exchanging the shares each other. It's called secondary market. So due to this transaction, the money flow among the investors, not with companies, right? So it's a market where investors purchase securities from other investors, not from the company, other investors, and not directly from the issuer, right? Secondary markets facilitate a variety of assets like loans, stocks, derivatives, centralized or fragmented liquid and illiquid assets. Right? So goal of the secondary market is to make capital appreciation. Capital appreciation. You might purchase the stock for 15 rupees and you keep the stocks for a period of time, then you can sell the stocks for about 30 rupees or 50 rupees. So this gap is margin capital appreciation. It's a profit for you, profit for the investor. And the price in the secondary markets is regulated by the market forces. The price market forces mean a demand and supply. If the company performs well, there are more, it creates more demand for the shares. If the company performs poor, then the company will the company the demand will low. So when demand is high, price will be high. Here company A, company B, C, D, all are listed companies on the stock exchange. And the stock exchange brokers, there are brokers. So if you want to buy, you can put a buy order through broker and investor. If you want to sell, and you have to instruct your broker and they will find the people, right? So the money flow between the investors, not between investor and company, right? Let us see the activities. So what are the benefits of money market to the economy? What are the benefits of primary and secondary market to the economy? Write the steps to purchase securities from a company under the initial public offering. Write the steps to purchase securities from the Colombian stock market. So these are the questions you have to answer. I have already given you an assignment. So I think it's going on. So I don't want to give another assignment and make you burden. First you submit that assignment, then I will decide whether you have to write the answer for this 4 marks, and we decide later on. And other markets, in other markets, commodity markets, we buy and sell commodities, sugar, wheat, paddy, right? This kind of things, commodity market. Derivative markets, derivatives, very important things, derivatives, future markets, insurance markets, foreign exchange markets. So very important thing we are going to discuss, that is what derivative markets, derivatives. And before that, we will discuss about first foreign exchange markets. It's easy to understand, what they mean by foreign exchange. And it is the system or process of converting one national currency into another and of transferring money from one country to another. When we make any transaction online from the internet, so the traders may be in China, the seller may be in China, US, or India, wherever in the world. We can give Sri Lankan rupees to them. They won't accept. So therefore, the common currency is US dollar. They accept US dollar. So at the time we have to buy US dollar. We have to buy US dollar from the bank. We have to buy from PayPal or other banks, right? And here we give Sri Lankan rupees and purchase a US dollar, and the seller will get the US dollar. So this time they are fixing price to buy 1 unit of US dollar, how much Sri Lankan rupees to be given to them. Exchange. Sometime you have US dollar and you have to convert this US dollar into Sri Lankan rupees. So this kind of transaction will happen in the foreign exchange market. The market where foreign exchange transaction take place is called a foreign exchange market. It does not refer a marketplace in a physical sense, in the term. In fact, it contains a number of dealers, banks, brokers engaged in the business of buying and selling foreign exchange. It also includes the central bank of each country and the treasury authorities who enter into this market as controlling authorities, right? So central banks or federal bank will involve very seriously on this market. Some people try to abuse their exchange market, and especially for money laundering. When we look at the functions of the foreign exchange market, the most important functions of these markets are: number one, to make necessary arrangements to transfer purchasing power from one country to another country. Once you purchase an item online from China, you have to transfer your purchasing power. When you are in Sri Lanka, your purchasing power is measured in terms of Sri Lankan rupees, and you have to transfer this purchasing power in rupees into the Chinese yuan, right? So we are transferring your purchasing power to provide adequate credit facilities for promotion of foreign trades. So, you imagine in the absence of foreign exchange market, how you can trade with other countries. If there is no market to exchange this US dollar to Sri Lankan rupees or Sri Lankan rupees to US dollar, so where we can find the common currency between foreign buyer or seller and local buyer and sellers, right? So it promotes the international trade. To cover foreign exchange risk by providing hedging facilities. So the foreign exchange market provides hedging facilities also. So hedging means they are trying to minimize foreign exchange risk. So you might study it in detail in other chapters. How to hedge a foreign exchange risk. This is very important. Derivative market. Derivative means the derive from somewhere, right? Derivative market. Derive. It's come from something else. Derivatives. So it is the financial markets for derivatives. Financial instruments like future contracts, options, which are derived from other form of assets. Is derived from other form of assets. So derivatives. In Sri Lankan context, it's hard to find derivatives. But when you consider foreign markets like new exchange, so you can find there are so many derivatives. A derivative is a contract, it's an agreement. Derivative is an agreement, it's a contract or financial instrument that derives its value from underlying assets such as a stock, bond, currency, index, or commodity. It is a little bit difficult to understand the concept derivatives, but if you know about the mechanism, it's very easy. Right? Many types of derivatives are available for trading, and future contract is one of the example. Other type of derivatives includes options, swaps, forwards, warrants, and convertible securities. The difference between derivatives and shares is that shares are priced due to the supply and demand, whereas the price of derivatives stem from price of other price of the underlying asset, right? Underlying asset. When we can divide the financial marketplace into two. First one is fundamental market. The fundamental market, our Sri Lankan stock exchange is one of the example for fundamental market. So where you can see stocks and bonds, stocks and bonds. But the derivatives market, we can find futures, forward contracts, options, swaps. Sometimes it may be new terminologies to you. Anyhow, so understanding this all the things is not our objective. Just we will have an understand of what it means. We don't want to know how it functions. No, we don't want to study in detail. So in surface level, we will discuss it. So what is derivative? A derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets. For example, I'll tell one example for derivative, right? You want currency. We take currency. Uh, you want to buy 1,000 US dollar after 6 months from today. Today price is for example 200 rupees per US dollar, but you need money after 6 months. After 6 months, 1,000 or 10,000 US dollar. Can you predict the price after 6 months from today? Can you predict after 6 month price? It may be higher or lower. So what you can do is you can enter into a contract from a bank that I want 1,000 US dollar on this date. It may be after 6 months on a specific date, but they are fixing the exchange rate today. Regardless the actual price after 6 months, they agreed a price today. Say, for example, they can fix 205 rupees per US dollar. They fixed, but the actual price after 6 months may be 210, 215, even 180 or 190. It may be higher or lower than the agreed price. Anyhow, you can get this $1,000 at price of 2,205 rupees per dollar. So this is an agreement. This agreement is one of the example of derivatives. So this contract, uh, the derivative is a contract. It's a contract. Derivative, it's an agreement. It's an agreement. Some agreement can be sell in the market, public market. Right? Anybody can buy and sell. So if you enter into if you enter an agreement to buy 1,000 US dollar from a bank, and you have signed an agreement with bank, and you keep this agreement until the maturity period, and then you can buy the US dollar from the bank at a agreed price. Or if you not wish to keep, if you are not willing to keep the agreement of 6 months, So you can sell the agreement to other person. Whoever keeps that agreement, he is the owner. He is the owner, right? Anybody can take it. So it sometimes people wanted to buy that agreement. So you sell that agreement, Mr. B. Mr. B won $1,000 after 6 months. So you can sell to Mr. B. Mr. B can sell to Mr. D. Likewise, right? It can be it's this agreement become a tradable instrument. This agreement become a tradable instrument. Therefore, this instrument can be bought and sold at the stock market, exchange. Derivatives, derivatives in the form of futures, forward, options, swaps, like that, right? Forward contract. So derivative is a financial security with a value that is reliant upon a derived form, an underlying asset or group of assets. So, for example, so the same example we take, the same agreement, you made a same agreement, US dollar. You want, the bank will agree to give you 1,000 US dollar at rupees 205, but now you observe, after the agreement you observe that the prices increases. Now the dollar become 250 rupees, but even though 250 or 300, but what the amount, whatever the amount, you can get this 1,000 US dollar at 205 rupees, right? So when if you decided to sell the agreement in the market, people know the price of US dollar is going to increase. So therefore, the people try to buy the agreement from you because it's cheaper now. If they keep this agreement, it's become cheaper. No need to spend 250 rupees to buy a US dollar after 6 months, rather than buying the contract from you. They can get benefit. So the value of the futures, value of the derivatives, it depends on the underlying assets. In this example, underlying asset is a US dollar, right? Uh, this kind of derivatives can be found in oil, crude oil, petroleum, and corn market, and coal, mining. So international market they are selling, no? Even nowadays they are selling market indices also. So Bitcoin, right? So there are many things. So in the commodity market, say sugar, you have an agreement with the sugar supplier, sugar exporter from India. You agreed, you have an agreement on the day. Sugar exporter, yes, 1 kilo of sugar is 100 rupees, and he want 10 tons of sugar, 10 tons of sugar at 100 rupees. You have an agreement. Then you sell that agreement in the market. I have an agreement, this type of agreement. So if anybody wanted to buy, can buy from him, from you, right? So if you expect that the sugar price will increase in the future, what will happen? The demand for the agreement will go up, and you can sell the agreement at higher prices. You are not selling sugar, but you are selling the agreement, a piece of paper, right? At the end, whoever having that agreement is eligible to go into the agreement, eligible to get sugar on that price. So the derivatives price, the agreement's price is depends on the sugar value, the price of the sugar. So you see in the derivative markets, derivative markets is a financial marketplace where financial instruments such as options, futures are traded. There are four participants in derivative markets. Hedges. Hedges mean the parties who are trying to reduce the risk. Try to reduce the risk, not for making profit. Rather than they are trying to reduce the profit, reduce the risk. Hedges. Speculators. Speculators mean they are guessing. Today the price is cheap. In the future, definitely the price will be increased. Therefore, they buy and stock the things, and later on they are selling at higher prices. So speculators. Arbitrages mean, you can find different prices in different places in different market. They sell the item at higher prices, and they buy the same item, same type of item in a different market at lower price. You see, the gold. What people do, the gold price in Sri Lanka is higher. The gold price in Singapore is low. So what they do is, the jewelry people, smugglers, they buy gold from Singapore and sell in Sri Lanka. And the gold price is higher than Sri Lanka in India. When you compare gold price in India and Sri Lanka, the gold price in India is higher than Sri Lanka. So what they do is they buy gold. They buy gold in Singapore and they sell in India. It's arbitrage, right? Arbitrages and margin traders. So types of derivatives. So exchange traded derivatives. You can openly sell that agreements. It includes contracts that are managed and regulated by the market. You can buy and sell this kind of agreement in the market openly. You can sell, buy and sell. And there are some agreement you cannot exchange publicly. You cannot trade publicly. So over the counter derivatives, over the counter, right? Whenever you want, you can go and take it. Over the counter derivatives are private agreements between investor but not traded on exchanges. And instruments. So what are the instruments you can find in derivative markets? And first one, options. Options means kind of choice. You have right but no obligations. By entering this agreement, you have a right. If you will, we can perform. You can proceed the agreement. If you're not willing to proceed, then you can leave it. It's a choice. It's called options. Options gives buyer a right to buy or sell assets at specific date or time. It's an agreement. And futures are the right to hold, to buy or sell the assets at agreed price date. So it's both the same, but the futures are standard one, right? Bulk. And forward contracts are same as futures. However, they are traded in the over the counter markets, right? So futures and forwards are, but it's compulsory. They have to perform. It's compulsory, but option is a right, not an obligation. It's not an obligation if it's based on the choice, right? And futures and forwards are almost same, but the futures can be sell at the exchange, but the forwards cannot be exchanged. Swaps mean swap is a fund flow. So it's an agreement between two firms to exchange their cash flows. Swaps allows parties to swap or exchange their financial obligations. Financial obligations. So when we talk about the advantages of derivative markets, so it ensures a ready market for derivative tools, offer incremental returns, allow risk hedging, allow choice between exchange rate or over the counter. When we talk about the disadvantages, so this is sometimes too risky for investors, experience high level of volatility risk, the price fluctuations are higher, and not as simple as primary or secondary market. And activities are similar to gambling but legal. It's kind of what gambling. Some people win, some people lose. A small explanation about the futures. The future, the owner of a future has obligations, right? The owner of the future has an obligation to sell or buy something in the future at a predetermined date. That's future. It's a standard one, standard. A forward, the owner of a forward has obligations like futures to sell or buy something in the future at predetermined price. Already they have decided a price. The difference to the future contract is that forwards are not standardized. What do you mean by standardized? A bulk, right? But so in the retail shop you can buy 500 grams of sugar, 1 kilo of sugar, 3 kilo of sugar. No, based on your requirement you can take, right? But can you buy this way from the factory, sugar factory? Can you buy 1 kilo, 2 kilos? No, you have to buy a bag, no, a bag of 50 kilograms. Even though if you want to buy 1 kilograms, they will give you choice. You can buy 50 kilograms, 50 kilograms a bag. So bags a lot consists of 50 kilograms. Like uh, in the oil market, we normally purchase in liters, but in the world market, they are dealing with barrels. Barrels, no, that is standard one. Lot. Options. The owner of the option has the option to buy or sell something at predetermined price and therefore more cost than future contract. So here, when you find the futures and forward, it's an obligations. But when you talk about the options, it's not an obligation, it's a choice. It's a right, but not a choice. In case of profit, he can proceed. In case of loss, he can leave it. You don't want to exercise it. And swaps. A swap is an agreement between two parties to exchange a sequence of cash flow. Sequence of cash flow. So these are the instruments traded in the markets under the derivative markets. Derivatives. Future is one form of derivative. Forward is one type of derivative. Like options, swaps, these are the types of derivatives. The name derivatives is a common name. Derivatives. The value of a particular asset is represented by another assets called derivatives, in simple terms. Forward contract, for your basic understanding, the forward contract between farmer and bread maker, right? Bakery, right? A farmer, he can supply wheat. They enter in agreement. The farmer and bread maker enter into agreement. Both are agreed, right? The farmer agreed to sell 500 kilograms of wheat at 40 kilograms, 40 rupees per kilogram after 3 months. So it means the farmer is obligated to sell 500 kilograms of wheat at 40 rupees after 3 months, regardless of the market price after 3 months. Right? Whether, right, this is a forward, no, forward. After 3 months, what will happen? The farmer should sell 500 kilograms of wheat at 40 kilograms, 40 rupees per kilogram. Therefore, he will receive 20,000, only 20,000, right? But when we consider as an option, so an option, a farmer has an option, put option, right? Put option. Option means it's a choice, not an obligation, right? It's not a forward contract. It's a option, right? Option, and in the option he agreed to sell 500 kilograms of wheat at 40 rupees to bread maker. Now the price, the market price after 3 months, the market price is 30 rupees per kilogram. 30 rupees per kilogram, right? That time farmer will be happy. Farmer will be happy. He has a put up, he has a rights to sell. Then the bread maker should buy the wheat at 40 rupees. Sometime the price is goes up 50 rupees per kilogram. This time farmer is not happy and he has a put option. Then he no need to sell the wheat to bread maker. He can sell at higher price, 50 rupees, to this bread maker or some other one, some others. So the difference between the forward and option is, the option is an agreement, but it it gives rights, it gives rights, but not an obligation. It's based on the choice of the holder, bond holder, the option holder. And the features of derivative markets, derivatives are popular instrument traded globally, and gain or loss depends on underlying assets value. Gains or loss depends on underlying assets value. In this case, the profit or loss is depends on the price of the wheat. Change in underlying asset will have effect on value of derivatives. They are traded on exchanges. Futures of derivatives can be traded in exchanges, and they are liquid and transaction cost is lower, right? So here are things, features of derivative markets. Functions of derivative markets. So it helps to risk management, price discovery, transactional efficiency, and financial engineering. So these are the functions of derivative markets. And who are the participants in the derivative markets? Hedgers, speculators, arbitrators, intermediaries, brokers, and jobbers. So these are the people participating in the market. You can find more detail about the what is contracts, a future contract, forward contract, options. I already explained to you. Warrants, swap, convertible securities, asset backed securities. So these are the forms of agreement. These are the agreements. What are the agreements? It makes an obligations, all right, and it's retainable. Then it is considered as a derivatives. Derivatives. So buy and selling agreement on underlying assets. It is in the form of anything. So characteristics, underlying assets, expiration date, reference price. So the risk, there are different risks, and so these are the things. The importance of derivative markets, futures and other types of derivatives are important financial vehicles because they facilitate commerce and allow market participants to set or assume risk. So this encourages increased participations in the asset market since traders can enter the market while controlling the risk. Most derivatives provide leverage that helps participants achieve their goals with less money. In addition, derivatives often predict the future price of underlying assets, thereby guiding economic activity. So the next part is financial instrument.